So many traders have been fed a lie that I need to get a higher RR to finally be profitable. But the real metric that actually proves your profitability is not risk to reward, not a bigger move, but expectancy. If this is a term you guys haven't heard of, great. Watch this video because we're going to be covering this concept and how it should be incorporated to every single trader's strategy, because this is the criteria that makes you guys profitable. If you're not focusing on understanding this metric and maximizing for it, then that's probably why you're not profitable. So let's get straight into the video and talk about what is expected or expectancy. So expectancy basically is a term that defines your average return per trade over the long run. What it is, it's a formula that calculates your risk to reward in conjunction with your win rate. Because we all know, well, actually, a lot of you guys probably don't know, risk to reward isn't the only important metric we need to track. Sure, it is important. You need to know how big of a move you're catching, where your stop loss is, where your take profit is, how much you're risking versus how much you're going to gain on the trade. But it's more important to know your expectancy, because expectancy combines your win rate with your risk to reward. If you know your risk to reward is pretty high, you generally know your win rate is going to be pretty low. There's a trade-off you make when trying to catch bigger moves versus how often those moves end up working in your favor. As the further away you say your take profit, because the markets don't generally have huge moves that you can actually capture on with a small stop loss, the further away you place your take profit, the lower the probabilities of the trade actually working out in your favor. And the higher the probability that it ends up going to your tight stop loss. That's why we always see traders who have a generally higher win rate usually have a lower risk to reward ratio. Like if someone has a 1-3, 1-5, or 1-10 RR, you'll likely see anything under 30% win rate, nothing over 50%. And if they are telling you over 50%, then that's probably a lie. So expectancy really combines the two values of risk to reward and win rate to tell you a true statistic of your profitable strat or of your strategy to determine whether it's profitable, unprofitable, or break even. Okay? We have to understand the balance between win rate and risk to reward, because it's not the fact that a higher win rate makes you more profitable or a higher risk to reward that makes you more profitable. It's the combination of both these two that makes you more profitable. All right? The formula is a very simple formula. We're talking about a little bit of maths here, but if you have anything more than the middle school or even high school level worth of math, you can understand this, maybe even middle school. But your expectancy, also called expected value, I don't know why I didn't write it, is determined by using this formula. Your win percentage times your average win minus your loss percentage times your average loss. Or you could substitute average win for reward for your risk to reward ratio and substitute average loss with your risk. Okay. Some of you guys might not be familiar with your average win or average loss per trade and just your RR, which will work in this situation too. So let's say we have a trader A. They have a 40% win rate with a 1-2 RR strategy. The way we can plug this in to find their expected value or their average return per trade in the long run is by simply putting their win rate 40% in the win percentage section, their average win, which with a 1-2 RR, you should be getting, let's say, risking $500, $1,000 on your reward, on your gain. So we'll put $1,000 as their gain, and we'll put their loss percentage, since 40% is their win rate. If we calculate 100% minus 40%, we get 60%. If they're winning 40% of the time, they're losing 60% of the time. And their risk to be $500, because double their risk is $1,000. So for every 1 unit of risk, $500, they're making 2 units for their reward, $1,000. And you could use the same formula down here as well. This is the second formula, which is that win rate times their reward from their risk to reward ratio minus their loss rate times their risk for the risk to reward ratio. If we simply do the maths, we get 0.8 times or 0.8 minus 0.6 using the second formula. For the upper formula, we'll get 400 minus, what is this? 300 minus 300. That gives us $100 return per trade on the top equals 100. And for the second equation, with the risk to reward, we get an average of plus 0.2 reward or 0.2 R per trade on average in the long run. All right, great. That's profitable, right? A per trader with a 40% win rate with a 1-2 average RR is going to be profitable because their expected value is above 0. If your expected value is above 0, that means you're profitable. If it's below 0, that means you're unprofitable. And if it's 0, that means you are break even. Okay? Now, your goal is to make this as big of a positive value as possible without making it making your strategy too crazy. Because if you try to get like a 40% win rate with a 1 to 10 RR, it's likely not going to be sustainable. So focus on just being slightly profitable, but maintaining a positive expected value. That's going to be your goal to be profitable, right? This person might not be catching too big of a move, but the fact that their win rate is pretty high while catching a 1 to 2 RR, that allows them to have a positive expected value, meaning they're going to be net positive in the long run. And now let's go over some more examples of different traders with different strategies that are also profitable as well. We have trader B, who risks 1 unit of risk to make 1 as well with a basic 1 to 1 RR. Same shit. Their win rate is 55%. So if you calculate their expectancy using the same formula, their win percentage, 0.55 times 1, which is their reward, minus their loss rate of 45% or 0.45 times 1 unit of risk, they come out to a plus 0.1 R per trade. That is profitable. It's not much, but it is profitable. A lot of people hate on 1 to 1 RR traders saying, oh, you're not profitable, you're not catching a big enough move. But if their win rate is anything above 50%, they're going to be profitable. All right. The reason I say 50%, because 50% win rate will make your expectancy become 0, right? This is plus 0.1, but if it came out to plus 0, that would mean your strategy's break even. All right. And if a strategy is anything above the break even value, maybe not just anything above, it's got to be above it by a little bit to capture or be able to still be profitable after fees and commissions. You need to make sure you're having at least a 50% win rate for this type of strategy to maintain profitability. All right. Anything above your break even, slightly above and higher, that's going to make you profitable. All right. And if your expected value is 0, that means that's your break even win rate or break even amount for the specific strategy. We have trader C down here, who risks 1 unit to make 3, a 1 to 3 RR. Definitely a lot of traders do that. With a 30% win rate, calculating their expectancy, plugging it into the formula, 0.3 or 30% times 3 reward minus their loss rate of 70% times their 1 unit of risk. That allows them to still be profitable with a 0.20 R per trade. This guy is slightly more profitable than this guy, but they have a higher RR and this one has a lower RR, and yet they're both still profitable. All right. Now, this might come to a shock. You don't need to be catching high RR trades. All you need is a specific strategy that has a positive expectancy, a positive expected value. As long as that's positive, as long as this number comes out greater than 0, your strategy is profitable, no matter how big your RR is and no matter how small your win rate is or how big your win rate is. Right? A lot of people do hate on negative RR traders, saying it's impossible to make negative RR work. How could you make money when your risk or when your reward is smaller than your risk? Many rewards will stack up and you'll have one risk that just wipes it all out. But if you really think about it, because the markets are almost random and the fact that it's pretty much your take profit is a lot closer than your stop loss, you're generally going to have trades that hit your take profit more often than your stop loss. So for example, if we just replace these values for 1 to 1, instead we have a trader who has 1 to 0.5 with a, let's say, 80% win rate. Because their take profit is closer, they're generally going to have a higher win rate. We can replace expectancy with 55 to 80 win rate now, and we could change this to 20% because 100 minus 80 is 20. We can change this value, their reward, to 0.5, and we could change this. We actually leave this to 1. And if we do the math real quick, let's do it. 0.8 times 0.5, that gives us 0.4 minus 0.2. So 0.4 minus 0.2, that gives us 0.2. So this guy is just as profitable. This strategy is just as profitable as this guy's strategy. Wow. But this guy has a negative RR versus this guy has a positive 1 to 3 RR. People might be like, this guy is unprofitable because he trades a negative RR strategy, but they don't realize it's a matter of combining these two values that make you profitable. These two values that make you profitable. Someone might have a 1 to 3 RR, but let's say they have a 20% win rate. They're going to be unprofitable. All right. And if you want, you could test this out, change this value to 2, plug it into the formula, see what you get. This times this gives you 0.6. This times this gives you 0.7. If we subtract this, you end up getting 0.1. Oh, sorry. Negative 0.1. Wow, that's sad. High RR trader exposed, not profitable. All right. And you might be asking, now, how can I change my RR and make my expectancy bigger? How can I increase my win rate to make my expected value higher so it can become profitable? Now, that's a whole different section that we need to cover. All right. You need to first understand what expectancy is, learn how to calculate, and then you can work on building an edge. All right. That's how you're going to make your expected value get higher, through backtesting and working on building a profitable strategy. Not catching higher moves, but testing out different risk to reward ratios and different take profit styles to see maybe your strategy works better with different risk to reward ratios. Maybe your strategy is unprofitable when you're trying to trade a 1 to 3 RR, but it's more profitable when you're trading a 0.5 RR style. All right. And you'll never know until you try it. That's why you'll see some strategies do better with different risk profiles. So give it a shot, learn expectancy, figure out how you can implement this with your own strategy, and run this equation with your current strategy. If you've backtested it already, plug in your values for your win percentage, your loss percentage, which is just literally 100 minus your win percentage, your reward and your risk, or if you don't know your risk to reward average, plug in your average win and your average loss dollar amount. That'll tell you on average how many dollars you make per trade in the long run. And the RR version will tell you on average how much R you make in the long run. And again, positive EV means profitable, negative E means unprofitable strategy, and 0 means break even. Give it a shot. Let me know down in the comments what your guys' expected value is, and if you guys found this formula and this video helpful. If there's any questions you guys got, let me know down in the comments. I'll go over it whenever I can. All right. Peace.